What's up, guys? Back with another video today, and we're going to get into mutual funds. So let's go ahead and get into it. Mutual funds is a pool of resources by small investors to where you can sell shares and use those proceeds to buy securities. So basically, if you're putting your money into a mutual fund, you're buying a group of securities in a way. So let's see. Assets held by mutual funds have also grown by about 17% per year over the past 25 years, and that is data from 2021. I don't know what it is for 2023, but pretty sure we could find that. But the main things to know about mutual funds, you'll say, why would I want to invest in one? So investing in a mutual fund has diversification, but let's get into 5 principal things about mutual funds first. So you have liquidity, which means that the investments can quickly turn into cash. So if you want to withdraw from a mutual fund, you can do that easily and you can turn that investment into cash. Number 2 is denomination, which means investors can participate in equity and debt offerings that individually require more capital than they possess. So what it's saying is that, hey, I cannot afford to buy this one share, but because of a mutual fund, I can buy that share. So you're putting your money into a mutual fund and they can get that share for you. Now, it helps you in a way to buy more things on the market because you're not doing it yourself. Say if you want to buy a stock that's $300, $400, you're like, I don't want to put that much money towards it in whole. Invest in a mutual fund, it'll do it for you because you're pulling your money into that mutual fund. Now, depends on how much you get back, but remember, you can get that stock even though you don't have the money or don't want to put the money in. Number 3, diversification. As I just said, investors immediately realize benefits of diversification because you can be diverse in different sectors. So for example, mutual funds, if you want to go into tech sectors, you want to go into real estate sectors, you can do that. You can have your assets put in different sectors in a mutual fund. So you don't have to worry about putting all your eggs in one basket. Say if a sector goes down, then you say, well, I got another sector that went up that can offset that. So you don't have to worry about putting all your investments in one sector and a mutual fund. Number 4, cost advantages. So it's kind of like what point 2 was about denomination. So the mutual fund can negotiate lower transaction fees because there's always a transaction fee behind anything. Sometimes on some brokerage websites or brokerage apps that you trade on, they may say $0 transaction fee. But here's the thing, the price may be a little bit, maybe $1, maybe $2 higher when you trade right then than it is in the actual market. So that is their transaction fee. They say no transaction fee because you don't see it saying, oh, you pay 50 cents for a transaction fee. You pay $0. That price differential from the actual market to the brokerage app is where your transaction fee lies. They're just not going to tell you that off the rip because you technically don't pay one, but you do pay one. And a mutual fund can negotiate lower transaction fees that are cost advantaging to you, the investor. Number 5 is managerial expertise. So many investors prefer to rely on pros to do their investing because if you don't know anything about the market, and see, I'm just doing this financial information literacy things to tell people about stuff. Not an FA, but I have a lot of knowledge in it because I went to school for it and I love doing this. So when somebody is a professional, and they tell you where to invest in because they've tracked the history, they've done their data log, and they've done their reports, they've done their Excels, they've done their graphs, etc. That is where people trust the most to say, hey, I can invest my money safely, and at least I know they could do it better than me. Because like I said for the video on large cap, small cap stocks, cheaper is not better. It's quality over quantity. Yes, some stocks that cost a lot of money, they're better in quality, because they're more well trusted, their balance sheet is good, their cash is good. Penny stocks, some companies may be great, have a lot of cash on hand, have millions of dollars, hundreds of millions of dollars of cash, but they don't have the whole industry, they don't have the sector, they don't monopolize or attempt to monopolize, they don't have a ground to stand on above everybody else in their sector. So cheaper is not always better, but because you have pros managing your mutual fund, you don't have to worry about that. Obviously, nobody's perfect, but would you rather take the risk of you investing when you have little information or no information, or would you rather have a professional do it for you? Now, another thing about mutual fund ownership is that it's increased in the past 30 years. So a lot of people want to diversify themselves and invest in a lot of things, but they may not have the funds to do so. So by going to a mutual fund, you're using that pool and you can invest in almost anything you want. So another thing about mutual funds that I want to talk about is that here's the structure. You have closed-end funds and open-end funds. So there's 2 types of funds. Closed-end funds are basically publicly traded investment companies, and they have a fixed number of non-redeemable shares. So you're saying non-redeemable, so I can't take my shares back and trade them in. So it's non-redeemable shares that are sold through an initial public offering traded on the over-the-counter market. And the price for the shares are determined by supply and demand. So to get in, basically you have to find someone exiting because they're non-redeemable shares. So you cannot say, well, I feel like trading today and then I want to take it back out tomorrow. You cannot do that. Under the closed-end fund rules, they happen to be redeemable whenever I guess the fund dictates. I got to get more information on that. But an open-ended fund, this is where investors may redeem shares at any point, anytime, when the price is determined by net asset value of the fund. So you're saying, what is net asset value then? So if I'm investing in something, what is net asset value if I want to invest in a fund that allows me to redeem my shares at any point? So net asset value is the total of the mutual fund securities, whether it's stocks, bonds, cash, other assets, minus the liabilities, divided by shares outstanding. So once again, it's all their securities, etc., any assets minus their liabilities divided by the shares outstanding. That's the net asset value. And investors/shareholders are owners of a mutual fund. So once you invest your money, you're putting it in. It's like a stock. So you say, I have ownership of this company now because I put my money inside this stock. Now you have ownership of a mutual fund because you put your money inside of a mutual fund. So you're probably asking, well, what's the overall consensus? What am I really getting from a mutual fund? You're getting diversification. So like I said, the biggest thing about a mutual fund is that you can invest somewhere that you cannot invest your whole money in. So what am I trying to say? I'm trying to say that, like I said, you can invest in a stock that you would say, I don't want to put that money towards. But if I do it in a mutual fund, I can grab a piece of that stock. So it helps you diversify and helps you keep your eggs in multiple baskets. That's the main thing about a mutual fund. So another thing is that mutual funds have classes. So they have stock, which is equity. They have bonds, hybrid, which is a combination between stocks and bonds. And they have money market funds. So the stock funds for a mutual fund, total return of funds seek a balance of current income and capital appreciation. So once you invest in a stock mutual fund, you're saying, I just want capital appreciation. I want to get my money back. I want to gain some money. You seek a return on your investment. And people that invest in those may want a rapid share price increase. They don't care about dividends. They don't care about getting a little bit back. They want a rapid increase. So when you invest in a stock mutual fund, you want to invest in something that's going to give you capital appreciation like that, quick. And then we go on to bond mutual funds. So bond mutual funds, they invest in corporate U.S. bonds primarily for SIFs. Government bonds are invested in U.S. Treasury bonds. So when you invest in a bond mutual fund, you're most likely just looking for something a lot more safer that won't have as much volatility as a stock mutual fund, and something that gives you some money back that's pretty much guaranteed when you go invest in bonds. Hybrid funds, combination of stock and bonds. So you're putting your money into more diversified assets and the bonds as well. Well, everything's asset there, but you're putting into the stocks and the bonds because you want to have diversification. You don't want to put your eggs in one basket because, say this, you invest inside of a stock mutual fund and then everything tanks. You lose your money, so now you're upset. But you invest in stock and bonds, maybe one can offset the other, and you won't have as big of a drop down as you would if you invested in one. And then you have money market funds, which are open-ended funds that only invest in money market securities, which I can get into another video about money market securities later, but just know that they invest in money market securities. And then index funds, a special type of mutual funds, they contain indexes. So indexes are our index of a stock. So an ETF, if you want to talk about the S&P 500, you got the SPYD, you got Vanguard, you got the Triple Q, and yeah, so you got Spider for S&P 500, etc. So what we're talking about is that index funds invest in those ETFs, exchange traded funds. That way you can have a piece of the S&P 500. You don't have to invest in every single company because you have that piece right there. So once you invest in an index fund, it's like a stock fund, but it's also like a bond fund. So it's like a hybrid in a way because it's safe to the primarily people that know about this stuff. It's relatively safer than actually putting it into a stock mutual fund, but at the same time, it may or may not have its drawbacks because, like I said, it goes with those companies in the market. So if the whole market tanks, that tanks as well. But indexes are made to grab the portions of the, for example, S&P 500, Spider. It grabs portions of all those companies inside the S&P 500, and you have a piece of them now. So you're being tracked on that market level. You're being tracked on those 500 companies. And then let's talk about fees of the investment funds. This is something that I wanted to get into because if you're investing in a mutual fund, you're going to have fees regardless. It just depends on what type of fee. So you have load funds with Class A shares. Class A shares charge an upfront fee for buying shares. So it cannot go above, and the book says, I believe, 8.5%. I think that is, and it is, yeah, 8.5%. So 8.5%, they cannot charge more of an upfront fee for Class A shares. So that's load funds. No load funds don't charge the fee. But Class B shares are called deferred load. So Class A is a load, so they charge an upfront fee. Deferred load, obviously on the back end. Class B shares, they charge a fee when shares are redeemed. So when you go into a Class A share mutual fund, you got to pay up front to get in. When you go to a Class B mutual fund, you pay when you get out, when you exit. And Class C shares, there's no fees for front end or back end, but where's most of those fees come from? Your 12B1 fee. Now, 12B1 fee is your marketing and advertising fee for funds, and they charge a lot of things, charge commissions, etc. So 12B1 fees mostly are by advertising and marketing, and they cannot exceed 0.75, yes, 75 basis points of the fund's average net assets per year. But that is where the fees come in on Class C shares, because like I said, Class A, you have a upfront fee, so if you got to pay to get in. You have a Class B share, you pay to get out. Class C shares, you're just taking on a bigger chunk of the marketing and advertising expense. So a mutual fund, what's the overall basis? What's the overall consensus that I'm trying to get you guys to understand? Is that you can diversify. And it's really good to invest in if you're an investor that's starting out, but you want to learn more about diversification and you want to have pro management. Now, here's a conflict about mutual funds, because when there's good, there's bad. There's principal agent problems, so maybe you won't communicate as much to the person you're trying to get with that's managing your money, because you say, I want to invest in this, but they say, no, invest in this because we're this type of mutual fund. So there may be problems that arise. There's late trading after 4 p.m., so things may go on in the market, volatility after hours, and then taking advantages of time zone differences will with the net asset value determination. So if you're in different time zones, you might have an issue because the market closes here at certain times, but you may be in different time zones. Say, well, it's not this time, but I need this fund or I need this investment at this time, but the market's closed. So it's a lot of things that go on with mutual funds because it's time matters. It's things that matter about your agent problems. But the main thing is that whether you invest in a mutual fund or not, they are pretty good to invest in. So I would say, not a recommendation. I'm not advising anything, but I'm just saying it's a good thing to invest in. Let's put it like that. It's a good thing to invest in. Mutual funds are diversifying for you. They're for diversification purposes. They help you with your liquidity. It just depends if you want to get closed in or open in. But just remember, mutual funds are pretty good if you're starting out investing, because if you don't want to hop in and say, well, I have a whole market to invest in, where am I going to invest? Diversify. Put your eggs in different baskets. Mutual funds. So guys, thanks for listening. If this was informative, just tell me. If you need some more information, let me know. I can do a second video, but thanks for watching. Thanks for tuning in. I will catch you guys next time.